Hello, good afternoon and welcome to the live trading hour brought to you by the Live Trade Room. What we'll be looking to do during this session is to look at across these markets from foreign exchange to commodities and also global indices. We want to identify where the higher probability trades lie and then look to trade them during this session if the opportunity presents itself. We do have a major news event, the FOMC this evening, where the markets are really focusing on what the next step is for the Fed in the US. They are currently buying bonds at a rate of 120 billion per month. Will they start to taper that process? Is there a need for that amount of quantitative easing? These financial institutions that and governments as well are at odds to say it's still very, very important that we stimulate the economy as much as possible. So it's really, if there's any kind of deviation from previous sentiment. So will the Fed actually look to taper slightly earlier than anticipated? As a result, will the interest rates start to increase slightly earlier? Because these two very important decisions will have major impacts for these markets, and they're clearly waiting for the next sort of fundamental driver. When that comes, that's likely to provide some very, very significant trading opportunities. However, unfortunately we're kind of trading this meandering market, which is there's a lack of clarity behind the fundamentals, and a lot of the technicals as well are very much sideways moving across most markets. So with all of this in mind, let's start the broadcast then. So we'll start with our risk warning. Please take a brief moment, familiarize yourself with the risks involved in course of trading these financial markets. Without that assumption of risk, there is no opportunity for reward. So it is about trading one with the other, but having a really sort of controlled approach to risk management. That's a fundamental part of trading these financial markets. Okay, so as always, let's start with a review of potential market moving news. So we want to be mindful of any major events that are likely to influence perhaps some of our trading decision making. So today now, as you can see, is Wednesday the 16th of June, and this afternoon we really have some CPI data, but largely impacting the Canadian dollar, as you can see. We don't really have much US data as we go into the FOMC this evening at 7 p.m. and this is UK time. We'll have the FOMC economic projections. We'll have the statement, the federal funds rate very much expected to be less than 0.25%. It's pretty much, this meeting is looking at the dot plot. At what point do we anticipate the rates to start increasing? If that shifts forward, then we're likely to get a very, very significant response from these financial markets. What's worrying is if they decide to do nothing new, and we might just get this little sideways pattern continuing. We are approaching the summer markets as well, which are historically kind of notorious for a lack of sort of direction and clarity, but we shall see. Every summer can have its own kind of trading characteristics, so we'll see what comes out in the wash. And at 7:30 UK time, we have the press conference by Jerome Powell. So he'll be asked he'll make a statement, and then he'll be asked a series of questions about the Fed's interpretation of what's going on in the economy, and of course their reaction to it. At this point, it's probably just worth referencing bond yields. The 10-year note is always a fairly stable indicator. If we look at what's been happening over the course of the week, we've had a very significant uptick in consumer price index, CPI, and also PPI, producer price index as well. So prices are clearly moving to the upside, but these markets are remaining virtually non-responsive. So we've got a 10-year note which is really struggling to kind of break above this 150 level. We have been as low as, I think it's a bit lower than that actually, around the 140. Oh, okay, so it is around the 145 level. So we're only just seeing a very sort of slight little pullback there over the last couple of days. But really, it's regarded as a subdued bond market with the 10-year around the 1.5%. We have been as high as 1.75, so we've seen a nice rollover to the downside as far as the 10-year bond yield is concerned. So what it means for us as traders, and how do we go about interpreting that, is, if I bring over our charts, is that the bond yields are still, for now, supporting the stock markets. So if bond yields tick higher, that's really not good news for your global indice markets. And if they move high enough in a short period of time, you're probably likely to see a very sort of negative response across the global indice markets. If inflation becomes a very significant problem, bond yields will push higher, and what that likely to do is to force the Fed into increasing interest rates to kind of offset that sort of pressure in the system, and then the cost of everyone's debt, increases, and that's likely to bring a whole host of other issues and concerns with it. And as you can see with the S&P 500 as well, we're only just trading at the monthly highs, so we're not having markets where we're seeing strong continuation, although we are seeing this kind of grinding higher price action now for the last let's say month. Well, you can go back even further, but we're getting long periods of nothing followed by really short impactful moves recently to the upside, but we are still tracking the monthly high. So if you look at this, there's a bullish bias to this monthly candlestick, but we're really struggling to kind of clear and break above that level. And again, we always refer to the fundamentals behind these markets. They're a little bit mixed right now. Technically they are grinding higher, but there's probably very little reason for them to drive higher. That's the reality of it, as we see in prices and inflation tick higher. So I guess the markets are just confident that the Fed are correct in the fact that it's transitory, it's not structural. So we keep hearing, although everyone's reality of these markets is and the costs of goods and services is that for most of us, we're all seeing these prices increase, but the Fed and the White House and Treasury departments are all at odds, to make it clear that, this is just a short-term impact. If they're correct, it'll be supportive for markets and they'll probably continue to grind higher. And if they're wrong, then we'll see very, very significant market corrections in the not too distant future. All of these things are likely to provide us with really great opportunities at some point. The question is when. That's what's really quite challenging at this time. So let's see what opportunities we have. Let's look at our trade plan from last night's trade plan webinar at 9 p.m. every evening, where we identify.
The US government confirms they've purchased an additional 200 million doses of the Moderna COVID vaccine.
Okay. So from last night's trade plan webinar, we identified a couple of opportunities. Sorry, if I just I'll tell you what I'll do is, let me get up my pen so you can see what our thoughts are as clearly as possible. Right, here we go. So we can all pretty much agree that this market's been in a sideways moving pattern for quite some time, in a relatively tight range.
Says the buy now
142
to 500 million doses.
142 and 140.60, let's say. So So we are really talking about 140 pip range, and it's just up and down, up and down, up and down within that period. So these market conditions are fine for scalpers. They're fine for those that trade consolidation. We trade momentum and direction, and clearly there's very little follow through. There's a lot of rejections of the highs and also the lows. We can see this very clearly, even as yesterday we saw this market break lower. It was prior to yesterday's retail sales figures and PPI numbers. We weren't comfortable getting into this trade yesterday. Off the bat, I'll share the price action with you. So we saw the initial break to the downside, and then prior to non-farm payroll, the retail sales figures, we saw another explosive move to the downside. When the numbers hit, we saw a really strong rejection in this market, back to previous, this is resistance, which now becomes support, and then we kind of drifted aimlessly sideways before actually reversing that trend completely. So this is the nature of these markets that you kind of need to build into your approach. On an ongoing basis, we're in very, very choppy sideways moving patterns. Vast majority of the price action within this tight range. And now, as of yesterday, we've kind of taken a little bit of a leg lower. There is this situation with the pound dollar where we've got marginal lower highs. Sorry, I'll put that in there. So we've got marginal lower highs. So it's reasonable to have a downward bias in this market. But this is strong support. And now has the potential to become resistance, and we've kind of broken through that. So it just leaves us with a big question mark over the viability to the downside at this time. If we did a little bit more technical analysis on this trade, the average price recently is kind of currently in and around this kind of area here. So if you take the highs and the lows out of the equation, roughly we're in the middle, and we're just trading above and below that particular level. And again, it just gives us that moment for pause. But we refrained from getting into this little drop yesterday, on the concern that if the retail sales figures, which let me show you what happened to retail sales yesterday. So we were talking about it, and there was positive expectations on the core retail sales figure, and we saw a minus 0.7, which is a very, very significant swing on a monthly basis. And then the retail sales, the monthly figure, we were expecting a negative minus 0.6, and we saw a minus 1.3. So very significant on the sales side of things. And this is at a time when the economy is bouncing back and beginning to open up. PPI figure, when we talk about inflation, we're expecting plus 0.5, and we're seeing a plus 0.8. So that's again for a monthly PPI figure, that's a significant uptick. We spoke briefly yesterday about the fact that this PPI figure over the last 5 months have come in way above expectations. So either the economists don't really know how to gauge these figures anymore, because we are seeing these very, very significant upticks in inflation, yet we are told there's no major concern here. So we shall see who's correct, I guess, in the not too distant future. Anyone trading the CAD, you got a CPI figure at 130. But really, these markets are really focusing on today's FOMC. So without further ado, let's see where the opportunities lie for this session, as we see some US capital coming in. So we're sort of preparing ourselves for some a little bit of short-term selling below yesterday's low. We haven't really broken below that low, so we don't have a trade that exists just yet for us. There's probably a mild risk-off approach to these markets, so we could sort of apply that logic and suggest that maybe there's a bit of upside for the US dollar, and we're not really seeing that either. In fact, the pound is much stronger than the US dollar, and the yen is performing better than the dollar. The CAD, the Aussie, and the New Zealand are all rebounding against the dollar. So it's not like we're seeing capital come out of your global indices and into the US dollar, which is what you would expect, you know, if you're taking recent correlations into account. But things like the yen, you know, is the yen strengthening? Then you can clearly see it's not. More so against the euro and the dollar, but not so much against the pound. So we're not really seeing the strength in the yen pairs either. So then we could look at gold. Are we seeing gold strengthen off the back of this inflation story? And the answer is no. So these are all markets that do not really stack up to any great extent for us right now. And there's clearly just a nervousness about these markets, and we wanted to see these markets for what they are. We don't want to create opportunities out of thin air, because that generally lends itself to taking unnecessary losses. So we've been through sort of consolidated markets and periods like this before. We'll continue to go through these periods, which is why one of the pillars that we speak about an awful lot to traders is your ability to be patient. That necessity to keep sort of pushing the button and getting into some of these trades that are giving us very clearly poor quality trade setups is not a good approach to adopt. So can we be, I guess, patient? Can we be disciplined? If we get into trades, if the opportunities, you know, if we're looking for an opportunity and the odds are stacking up, and we can support the opportunity with credible analysis, either on the technical, fundamental, or the sentiment side, and we get a sort of a no-brainer opportunity, by all means get into it. Maybe reduce down trade size. That's one strategy that you can adopt. A lot of new and inexperienced traders will throw their strategy out the window because they're looking for breakout trades, and they're quite difficult to get hold of right now. And they are we're in this consolidated trading condition, so they'll throw their trading strategy out the window, and they'll look to adopt, I suppose, a negative risk reward or a scalpers type trading strategy. And then lo and behold, when that happens, the markets will explode, and they'll just get ready, and then you'll be stuck again because you'll be missing out on all these fantastic opportunities. So instead of getting yourself into that trap, which is really what it is, can we be patient during these long periods of nothing, as you can see, with very, very brief opportunities of some opportunities, some price action, and some of these are kind of late day moves. It's not like, you know, they occur at the most appropriate times of the trading day like they used to perhaps a couple of years ago. So we have to kind of adapt as these markets adapt, and trade size is one thing. You can reduce down your trade size so your overall exposure is slightly reduced, and you could increase your stop loss placement. So you can get into the trade, maybe consider reducing the trade size a little bit, and you might want to work with slightly larger technical stop losses, as opposed to you know, throwing your strategy out the door and looking to adopt a very, very different approach. Because the one thing about financial markets is that the market conditions ebb and flow. They'll go from really tight conditions to really explosive conditions to really tight, and we get reversal signals, and then we'll get through these tight phases. So that's not an unusual type of trading chart. And the thing is, if we're nice and calm during these periods and we can get these little breakout trades, and we can be nice and calm through further consolidation, we can get involved in the selling trade, and waiting for these moves, you might get into one, you might get multiple opportunities maybe in a move like this. The opportunities might be few and far between, but they're likely to be really quite profitable ones. So I digress a little bit. Let's just see where the opportunities lie. So when we look at the S&P, there's absolutely nothing happening in there. We're getting a similar signal from the euro dollar. It's just a 3-day sideways moving pattern. We speak about the last couple of evenings, just be mindful going into this FOMC, because we're not getting any price action in the build up to the event. So what that often means is that meandering market conditions likely to sustain itself up until the FOMC. And all it means is traders are sitting on their hands right now. Traders and investors are saying, we're not committing to the upside or to the downside right now. We're going to sit on our hands, and we are going to take the trading opportunities at a more appropriate time. And that's exactly what we're looking to do. We always talk about the commitment of others. Trading is not about our opinion. It's got nothing to do with our own bias when we trade. We're interested in the commitment of others, in those that want to commit to markets in certain directions. And we're talking about your Wall Street banks, you're talking about your hedge funds, your global financial institutions. We're talking about the decisions that they make, which are really important to traders. Not our own, we've got to manage our own account. We've got to make, hopefully, consistent decisions with discipline. But really, patience is something that should not be underestimated, especially during quite challenging market conditions. And we could be trading the markets from 8 in the morning to 4 o'clock in the afternoon. We might get very, very little opportunity, but then at 7 o'clock in the evening, we could see prices absolutely explode. That's been, I suppose, a little bit more of the reality over the last year or two. We've seen some very strange late day moves where you'd always experience the most volatility during the largest trading period, which is clearly sort of the European hub, the sort of the 8 to 5 time frame is probably the largest on a global basis on a trading day. And you can see very, very little price action during that period. And then, when the US, when the European markets, retire for the day, then we can see some really important price action occurring at slightly unusual times. But again, that's what trading's about. It's about, are you able to adapt? Now, trading at those times is not that convenient for many traders, for non-trading reasons like family and commitments and things like that. So it is a bit of a tough one. The other thing that we always used to use, which was pending orders when we trade. Viable strategy to adopt. If you're really sure and positive about a particular price point, you can place a pending order. The problem is the nature of this market right now is very much indecisive. So we're seeing an awful lot of false breakouts. So we don't have major confidence on placing pending orders right now as well. The good news is all trends start from consolidation. So if you go back and look at any uptrend, it goes through prolonged periods of consolidated price action. And it just allows the market to catch up. It allows people to see it on various different time frames, like weekly and monthly, traders and investors as well. They'll all catch up, and then there's this collective psychology behind these markets where they'll all start, you know, pushing prices higher, and we want to try and capitalize on that psychology as well. Okay, so so really we're looking at very, very significant markets which are giving us mixed signals. So the dollar's weaker against the pound, it's stronger, it's weaker against the yen, nothing happening against the euro, it's stronger against the Swiss franc. The Canadian dollar is stronger against the dollar. The dollar is much weaker against the Aussie and the New Zealand. So when we're looking at trading the majors, we don't have great opportunities to work with. The euro pound, we really like this market to the downside. We're edging closer to what we would expect, which is a clearly defined close. We're looking at that 85.80 level. Let's have a look at it on the smaller term time frame. So we are just making this little move, and we're at the 85.80 now. So our bias is clearly to the downside. Let's have a look at it on the hourly. The problem is, anyone trading this over the last well, since the, what date is this? The 26th of April. You know, you'll just be caught up in a lot of this really, really choppy price action. So the reality is we're kind of drifting sideways. This is just a kind of another example. So now we're edging down to these lows here, the 85.80 at the low. So what's happened previously? We've seen some buying coming in at these lows on numerous occasions. So technical analysts will identify this, and that's what's likely to happen again at these current prices. So there's going to be an awful lot looking at these lows, looking for buying opportunities. What we can plan for, if I can, yeah, so what we can look for is not look for these. There's a descending triangle there for those of you that are familiar with your technical analysis. So we look for oh, sorry. Let me take that out again. We look for psychological stress points in these markets, also sort of known as support and resistance. So the technical advantage of support and resistance is, like I said, you get buyers coming in at the lows and you get sellers coming in at the highs. So, but there's a narrowing of price action. As you can see, the range between highs and lows gets narrower and narrower. So instead of looking for these sort of medium probability trades where you're looking to scalp, you know, like a shorter term swing, what we're waiting for, and we've been waiting really, really patiently because we've had a couple of false breakouts to the downside already, is a confirmed break to the downside, which we've kind of failed to see to any great extent so far. So if this one gives us the confirmation below that 85.80 level, then we have a green light to take this further to the downside. The problem is we've been here a few times before. Will we get the move today or tomorrow? We'll of course we'll just have to wait and see. But that's kind of how we're reading these markets. We're wanting to see that psychological. We want to see the psychology in this market begin to shift, and that's roughly around these levels here. So has this market got the got the potential to close below this level. It absolutely does. When it does, it's important to, I suppose, note what happens at these levels. These are all your buyers. So there's lots of buying coming in at these levels on many occasions. They look for prices to get down to these levels, and all they're looking to do is to push higher. So if we agree this is from a psychology perspective, this is an important level, because if prices close below this level, this is when all these buyers, they'll have their stop losses piled up normally around these levels. So this is order flow, and you can see some of your financial institutions have real good information behind where people's stop losses are placed. So
we're just under 10 minutes away from the bottom of the hour. A raft of US and Canadian data to take down. We'll be leading with the UK housing data.
I'll put that back on in a second. That's why you often get what's called a little bit of stop loss chasing, because they can push prices to those levels to clear out people's stops. They very well may get back into those trades again, but the market's clearly not ready to the downside. So you can get in on the breakout trade in these, but they're false breakouts, so they'll end up in losing trades. But this is the harsh reality, and every time this market bounces back above strong levels of support, you'll see some more buying coming in time after time again. Now that requires a certain experience level, and these are all your hedge funds and institutions, looking to buy at these particular levels, and now sort of retail traders having more of an impact on these markets. But it's the psychological shift in this market, which is what's really quite interesting. When all of these, you almost break the hearts of all of these buyers in this market, and stop losses are tripped. Even those that don't trade with a stop loss will be exiting it down at these levels. They turn to they turn to sell orders, and the net result of that is often an explosive move further to the downside. And you'll see this time after time again. You'll get just a sharp move further to the downside. So this is the downward pressure that's being applied on this market, and what we're waiting for, very patiently I might add, is that breakout trade below those levels. And there's your high probability trade. Most of these opportunities in the up and down are kind of medium to low quality trades, and you need a very specific skill set for those. You can see the false breakouts to the upside and to the downside in these markets. So it can be quite a tough journey. But the breakout trade to the downside, where you can add to pullbacks and things like that, is something we should really look to focus on, and be ready to pull the trigger when prices do close below this level down here, because it's likely to be a decent quality trade. The other thing is, the longer these markets move sideways, the more explosive moves we're likely to see down at these levels. So worth keeping an eye out for. Okay, so where do the opportunities lie in these? We're getting too many reversal, too many sort of mixed signals in these markets. The euro pound would certainly be an interesting one to the downside. The pound yen, it's just sideways moving patterns, and what we're seeing, and again it's just another example of kind of these market conditions. But we're seeing prolonged periods of sideways moving patterns along with sort of relatively small explosive moves, and that does make this trading a lot more frustrating right now. So there's an argument to sell the euro yen to the downside. There's your indecision candlestick. It's almost kind of a standalone type trade. The other thing as well is we're really comfortable when the correlations fit. We don't really like outliers, which is just one random market that just flies off, on its merry way without any sort of fundamental reasoning. If there's a reason for that market to be pushing higher or lower, then absolutely look to get into it. But so we've had I suppose the biggest move really in all of these markets is the crude oil, and we are up at these highs. We've got crude oil inventories today. Let me share with you the time for that particular event. No, it's not Thursday yet, is it? So crude oil inventories 330, and we're expecting another negative figure. And just to be clear, if we're seeing these crude oil inventories show a negative figure, then it's likely to push up the demand for crude oil. And if there's more demand for crude oil, prices are likely to push higher. OPEC have been tapering the oil markets for quite some time. They're slowly beginning to unwind. Sorry, let me rephrase that. OPEC Plus have been restricting the supply of oil for quite some time. Now they're just on the verge of beginning to taper, i.e. remove the supply restrictions, increase more supply into the market. As economies are coming back online, there's increased demand. So they're allowing more supply to be readily available. So they're tapering their supply because they anticipate the demand to be there. And if the crude oil inventory number is negative, then it's likely to push up demand. So if you see minus 2.5 million barrels, for example, then you'll see it in green because it's better than expected for the price of crude oil. And the same also applies to the downside. If it's minus 1.1 million barrels, for example, then the inventory number is not as per expectation, and you might start seeing some very subtle impacts on the supply demand curve for crude oil. And the net result on the price of crude oil is that you're likely to see it just roll over to the downside a little bit more. So a negative green number would push prices higher. Let me just say it's likely to push prices higher. It doesn't always follow through. Sometimes you can have positive news, negative price action. So that's when it just gets a little bit more challenging. We're looking at these markets. We're at 130. We've got a very, very significant news event today. So we're not really going to keep you hanging on any longer, guys. There's simply no need. We will probably be taking the afternoon off and get ready for the FOMC tonight at 7 p.m. And the real reason being is this commitment of others. It's a bit wishy-washy. It's a bit all over the place. We don't want to work too hard for a sort of a medium probability opportunity or a low probability trade. We don't need to tie up our capital in that way. Once we get a bit of a green light, there might be some fantastic opportunities later on this evening. Okay, so we would actually in this session probably recommend you guys to keep your powder dry for this session this afternoon. The only deviation off that is if we started seeing some very significant moves, which we're not currently from the most liquid markets out there. So So let's keep hold of our capital. Let's not commit it to any particular trade in any particular direction. Let's see what we get from the FOMC later on. But here's something to be mindful of. If the Fed talk about tapering their massive bond buying program, then expect fireworks this evening. If they refrain from doing that, if they're still not concerned about the inflation story, and there's a couple of sort of weights that's just pulling down the expectations, and it's not structural, and there's issues with unemployment and all this kind of stuff, then we can expect some continuing price action. However, the markets are watching very, very carefully today, just to see what the Fed decide to come out with. The expectation really is either September or October of this year before they'll start talking about tapering. But if they decide against that, and they're in talks at the moment, and we'll see what they come out with later on, then we can expect fireworks at that point. So look, on that note, guys, thank you very much for joining us. We will let you guys go at this stage, and we'll be back again tomorrow at 12:30. Please do give us a thumbs up if you can, if you've enjoyed the broadcast, and we'll be back again tomorrow at 12:30. So we hope you can join us for what we hope will be a little bit more of an active trading week. The last 2 or 3 days, the opportunity has been really few and far between. Okay, so look, thanks very much for joining us as always. Take care, and we look forward to seeing you next time. From everyone here at the Live Trade Room, bye for now.